Welcome to today's webinar, 6 Key Steps to Buying a New Home. My name is Rebecca Lubert. I am the Director of Career and Business Engagement with the Alumni Association, and I welcome you to today's webinar. I am here today with our presenter, Dave Petroske. Dave is a Senior Mortgage Loan Advisor at TCF Home Loans. Today's webinar is brought to you by TCF Bank, the official bank of the Alumni Association. And I'd also like to thank our members of the Alumni Association for making our alumni webinar series possible. Thank you for your membership. And if you're interested in becoming a member, go to umnalumni.org/membership. You might be interested in some of our upcoming events. As you can see, we have a number of webinars and in-person workshops available. To find out more, visit umnalumni.org. And if you're interested in tuning in via Zoom, you may follow information on your screen here. And you can see there's a particular webinar ID as well. So that's your option for listening in via Zoom. If you have any questions, you're welcome to submit them at any time, but we will reserve Q&A towards the end of our presentation today. Oops. All right, so without further ado, I'd like to introduce our presenter, Dave Petroske. Dave is a Senior Mortgage Loan Advisor at TCF Home Loans. His goal is to provide individuals with solutions tailored to their specific needs. He reviews all the details and objectives with clients to ensure that everyone is on the same page. Customers remember the smooth process long after the closing is completed. Results of this performance can be found in Dave being selected as a multiple year winner by Minneapolis, St. Paul, and Twin Cities Business Magazine as one of Minnesota's super mortgage professionals. Welcome, Dave, and I'm going to hand it over to you.
Great. Thank you, Rebecca, and good afternoon, everybody. Alumni, I hope everybody is doing well and having a nice day so far, and I certainly want to thank everybody for spending some time here today to learn a little bit more about the steps of owning a home and how to purchase real estate in Minnesota. It's an exciting time right now in the real estate market. It's very active, and I'm sure we've all heard of lots of great stories of people getting into their first homes and really having some life-changing events in that process. So today we're going to have a little fun with this. We're going to learn a little bit, and if you have some questions at the end, we'll go ahead and allow you to ask a few of them while time allows. And with that, we'll go ahead and get right into it. So again, I want to thank everybody for joining our home buyer seminar. And today, really what we're going to talk about are kind of what we've classified as 6 steps to owning a home. And this is not all the steps required, but we think it's really more of a 30,000-foot view of what it takes to get into buying a home here today and in 2020 and obviously beyond. So again, the one thing to remember is everybody here that's paying attention and participating in our webinar, everyone's different, everyone's unique, and so everyone's situations are unique in and of themselves. And so we want to make sure that we're letting people know that that when you are looking for a home, it's really your situation that matters. And that's really what we want to try to focus on here today. So let's go ahead and we'll get started here. So as Rebecca mentioned, I'm a 20-year mortgage professional. I'm just shy of 2 years with TCF. And realistically, in the 20 years, the mortgage market has changed dramatically. It's become much more what I'm going to call consumer friendly, which for all of us out there is really appreciated. And really what we want to learn here today is have some takeaways that we can take with us so that when we do decide, whether it's this year or next year or in the future, to take the jump to purchase a home, that basically we're prepared with information to be able to make really good decisions and choices in that process. So in the steps that we've talked about, really in the 6 steps, what I wanted to cover today was I wanted to talk about reviewing your financial health. That's really a key element. All of these are obviously key elements for us, but I want to talk about what it means to review your financial health. I want to talk about meeting with lenders and some of the things you should be on the lookout for, some of the things you should be listening for as well. We want to talk about when you're finding a home, what steps are involved in that. Once you do find a home, there's a whole new process revolving around making an offer and finalizing the purchase of that home as well. At the very end, the fun part of the whole transaction is the closing part, and that's the exciting part. And that's one of the things that really, when we're going through this stuff, the closing part of the equation, people, should really be a formality. It needs to be a fun activity. It needs to be a fun meeting. And hopefully, if everything is done on the front end of the process, your closing is going to be fun, and it's going to be enjoyable, and it's going to be a stress-free activity. So that's really what we're trying to get here to do for us today. So let's get into kind of the first step, which is reviewing your financial health. So in reviewing the financial health, for anybody that's dreamed about owning a home, I think can be a lot of misconceptions out there about realistically what it takes to be able to buy a home. And what it takes really, I think, starts with a personal review of your own assets that you have and your liabilities. And when we talk about assets, we're talking about things like your bank accounts and your savings accounts. When we talk about liabilities, we're talking about things like credit card debt. For many of the alumni here, potentially student loan debt. And so those are things that we want to be able to focus on, because that's going to help determine the price of the house that you should be shopping for. Spending, we want to talk a little bit about the spending part of the equation and knowing what your spending habits are, because at the end of the day, I think it's important for all of us to realize that when we're all done, we've purchased our home, our real estate agent is now gone, our lender's gone, the title people are all gone, and we're in the home, we want to be able to be comfortable with the payments that we have to make. And we've all heard the term being house poor. Realistically, if you're working with good lenders, they're going to have that in your mindset to help you understand, to make sure that you are getting into a situation that financially is beneficial for you. It's not beneficial for an agent, it's not beneficial for the lender, but it's beneficial for you, the consumer. And realistically, that's what we want to be focusing a lot of our attention on. When we talk about the purchasing a home and the financial health part of the equation, you should, as a consumer, realistically start to have some money put aside, because you will have expenses involved in a process here that are above and beyond just things like down payment or closing costs, which we'll get into. So the key to having a good savings account and starting savings for the purchase of a home is something that you really want to start taking advantage of maybe a year or 2 or even 3 years in advance of your intent of wanting to buy a home. Having a good credit profile, realistically today, can be probably one of the, to me personally, is the most key element in home buying. And I want to talk about, at this point, I want to move forward to talking about credit scoring, because credit scoring in and of itself is kind of a behind the curtain viewpoint for a lot of people. We hear about it, but realistically, how many of us really understand what a credit score is or what goes into a credit report itself? And so what I wanted to do was put together a summary here for all of us to be able to use to talk about your credit scores. Now, credit scoring in mortgage financing is going to be made up of the 3 major credit bureaus that are out there: TransUnion, Equifax, and Experian. And these are 3 independent organizations that generate credit scores. And when lenders pull your credit, they're going to pull credit from all 3 of these bureaus. Each of these bureaus actually has their own metrics of how they determine what your credit score is, but it's basically going to be a numeric number anywhere from about 350 up to about 850. And the key element is that on your credit score, the credit score that you have personally will dictate the terms and conditions of a mortgage loan that you're going to take out. So when you hear of a neighbor or a friend who just bought a home and maybe procured a certain interest rate, you have to remember what we talked about previously. That's their credit profile. That's their situation. That may be different from yours. So again, it's important to understand, even before you get into purchasing a home, to have an idea of what your credit profile looks like. And in the information further on down the road here, we're going to talk about looking at annualcreditreport.com, which is a place where consumers can go to get a free credit report. Now, the one thing I do want to caution you is that when you do it, you're getting a credit report which is telling you about all the debts that you do have. It is not generating a score. If you want a score generated from the free annualreport.com, that's something that you will have to pay for. On the flip side, there are groups like Credit Karma. There are some credit cards that actually will offer free credit scores to you. The metrics that they use are going to be slightly different than the three bureaus, but again, what they will be is give you at least an idea of what your credit score is, and so I encourage all of us out there to make sure we're checking on that. Getting back to the scoring itself, when you look at credit scoring, there are 5 different categories of what make up our credit score. The first one, which is the most weighted average, is our payment history. So 35% of your credit score is created through the history that you have of how often you pay your bills. Do you pay on time? Do you pay maybe more than the minimum payment? So your history of making payments is a key element into having a good credit score. The second weighted average is based on the amounts owed. And when we talk about the amounts owed, consider it this way. If I have a credit card that has a $5,000 limit and I owe $1,000, well, that's a fairly small limit of credit used on that score. And we've heard terms of having our credit cards maxed out. Well, that's really what it is that if I've got a credit card that's got a $5,000 limit on it and I owe $4,900, that card is pretty much maxed out, and that can be a detriment to your credit score. The length of credit history is kind of the third weighted average, and that has a 15% accuracy or 15% weighted average into our score. And when we talk about the length of credit history, we're talking about, do I have credit that's new? Do I have credit cards that are new? Do I have scores that are new? Do I have credit cards that are older? So if I've got cards that are 5, 6, 7 years old, those are good numbers to have, and we want to continue to make sure that we have long-term credit. The fourth weighted average is based on our new credit. As a consumer, am I out there applying for new credit constantly? And when I'm out there applying for new credit and there are pulls on my credit, those types of activities can help drag our score down a little bit. So when we get to a point of when we are starting to shop for homes and wanting to pre-qualify for homes, we really want to have our new credit opportunities stopped, and we don't want to be out there searching for new credit because, again, that can have an impact on the scores that you end up having. And the last mix is the 10% mix in our matrix, is the actual credit mix itself. And when we talk about credit mix, it's the types of credits I have. Do I have a house loan? Do I have credit cards? Do I have car loans? Do I have student loans? So if I've got a various mix, that also shows that I'm a good credit risk person, and you can, as a bank, you can feel good about lending me money. So again, these are real important things to think about, and I would encourage everybody to go ahead and make sure that they are checking credit scores or having a lender check a credit score well in advance of searching for homes, because if there are things that are on your credit report that maybe are in error or things that you didn't know about, those are times where you want to go ahead and have them fixed. And the one thing I do want to caution about is that fixing things on credit reports does take time. It is not a rapid improvement. It's not a rapid fix. credit scoring and credit repair does take time. So again, I would reach out to your lender to talk about those types of things so that you do have opportunities to be able to advance those discussions as needed. The next topic I wanted to talk about is something that I'm obviously well versed in, and that's meeting with your lenders. And the reason you want to meet with a lender and talk to a lender in person is that this is an individual that's going to be working with you throughout the process. You need to feel comfortable with that lender because they're the ones that are going to be advising you as you go out through your process. Now, when you're talking to lenders, you have to remember it's not what's my rate. If the question right out of the gate is what's my rate, that's really the wrong question. It's tell me about your company. Tell me about how you work as a lender. Tell me what I can expect if we deal together from things like communication, from options, from being helpful. Those are the types of questions you want to ask to make sure that the person that you are working with is really somebody that you want to work with throughout the period of the transaction. It's going to be the same thing with a real estate agent. You need to feel comfortable that they're looking at you as saying, what's in the best interest of the client? If you have the impression of they're interested in what's most important for them, that's probably not the right person at that point. So what a lender will end up doing is once you sit down with them is they should be talking to you about what your goals are. They should be asking you questions about what would you like to do. They should be helping you understand the process involved so that you have a clear understanding of that once you get started. Realistically, what does our roadmap look like until we get to purchasing a home? And when you meet with that lender, make sure you do have questions prepared in advance of things you want to know about. Because if you get in the meeting and things all of a sudden start going along real exciting and you forget about your questions, well, that's not helpful. You want to be able to have a list of things that are important to you that you're sharing with a lender to make sure that they are addressing your needs as well as educating. And realistically, that's what a lender is there to do, is to educate you on the process. You also need to be organized when meeting with lenders. You want to make sure that you have financial documentation ready and available. And when we talk about financial documentation, we're talking about things like your W-2, your pay stubs, maybe a tax return if you happen to be a self-employed or if you own your own business, and bank account statements. Those are the things that are going to help a lender help you make a determination of realistically what a good price range for shopping is for you. And it's important to know that because if you're out looking at real estate websites, how do you know what a good price range is for you or what are ranges that you're going to qualify for? And that's what the lender meetings can end up doing for you and helping you do that. When you're sitting down with a lender, one of the things they're going to talk about is payment. And in talking about mortgage payment, the mortgage payment itself is broken into what we call in our industry of PITI, and that's principal and interest, taxes, and insurance. And so breaking it down into more of the specific parts of that equation. The principal and interest are the part of a mortgage payment that you're paying back to the bank, and that's paying down the principal and paying the interest that you owe for borrowing that money. And the principal and interest on a fixed rate mortgage, once you enter into that agreement, won't change. That will always be the constant. The second part of the equation is going to be the escrow account. And the escrow part of the equation will deal with property taxes and homeowners insurance. And those will be set up in a monthly basis that will be part of your payment. And if you have less than 20% down, having an escrow in your monthly payment is required. Now, also in the escrow payment will be a concept called mortgage insurance. And mortgage insurance is put onto a loan if a consumer has less than 20% down. And it's basically, it's an insurance premium that's paid to the lender due to the borrower not having 20% down. And there are a couple of ways to handle mortgage insurance. We won't get into that today, but those are topics that you can know that it doesn't have to necessarily be a monthly payment. It can be something that can be absorbed into a one-time fee or something that can be absorbed into a slightly higher interest rate. But when you look at those four components of principal, interest, the taxes, insurance, that is the forming of a monthly payment. One of the topics I do want to talk about is that condominiums and townhomes have a separate additional component that is not factored into the PITI, and that's homeowners association dues. So you need to remember that when a lender is talking to you about PITI or mortgage payment, and you're shopping for a condominium or you're shopping for a townhome, you have to remember that that is also part of a monthly commitment that you are making to live in that complex. It's just not included in your mortgage payment, but that monthly payment will be included in your debts that you have, and that goes into your qualifications. So the next thing that I want to talk about is finding a home. And once you've met with your lender, which I again encourage before you start searching, he's going to help you or she is going to help you find a price range that really meets the box that you should be in related to the monthly payment, related to any down payment that you have, to help you make a decision in your shopping. And when you do shop for homes, you have to remember that a $300,000 house is going to look much better than a $250,000 house, which will look much better than a $200,000 house. So it's important to know your range, and especially if you're a first-time home buyer, it's also important to remember that the home that you're buying today may not be the home that you're going to be in 10 years. So if you have life changes, this is your starter home. This is my getting into the market home, because in 5, 6, 8 years, when your life changes, you may be selling that home and moving up. So it's important to remember that the home you get in as a first home is not going to be your end home in most cases. In working with our budgets, it's important to make sure that we're keeping payment in mind and we're keeping down payment in mind. And we also want to make sure that we're keeping in touch with the timelines that it takes to actually purchase a home. When we're out looking at homes and we are shopping, ultimately what will end up happening is that at some point you're going to see a home that you're going to want to make an offer on. And what I encourage everybody is, before you're ready to make that offer, contact your lender and talk to them about, hey, if I want to make an offer on this home, can you please share with me specifically what it's going to look like to be able to buy the home? Can you tell me roughly what my monthly payment is? And can you tell me approximately how much cash I'll need in order to execute the purchase? Because it's important to know those two key elements before you make an offer, because quite frankly, properties are all different. The taxes are different. So if I have two homes that are $300,000, the property taxes are going to be different on those two, and one might be $50 or $75 more per month. Well, you have to make a determination, am I okay with that? Am I comfortable stepping up for that extra bit to be able to purchase that home? Because once you do, and you're comfortable with that, now you have the basis for feeling comfortable in making your offer. So when you do make your offer, what will end up happening is that your lender will send a pre-approval letter specific to your agent, and that agent will then send that letter along with your offer onto the listing agent. And at that point, it's let's make a deal. So there is a negotiation that's going on there. The one thing I do want to caution everybody is that all the real estate shows that we see on HGTV, their processes that they run through is going to be quite different than what real life is. So take that with a grain of salt, that the things that you're seeing on the HGTV channel, again, are for entertainment purposes only, and they're not to be taken for, for anything other than that. And that's what your real estate agent and your lender are here to do, is to help you understand really processes. Once you make an offer, you're going to have a negotiation back and forth with that agent, and making sure that if they're countering your offer and saying, hey, I won't sell it to you for $250, but I'll sell it to you for $260, are you comfortable making that payment? Are you comfortable paying that price for that home? And that's where the back and forth comes into play, and typically that's going to take several days of back and forth going. But once you do have an agreed upon purchase price at that point, now the clock starts ticking. And what you will end up doing is, the next step is your agent will encourage you to have an inspection done of the property to make sure that the foundation is good, the roof is good, the HVAC systems, the electrical, the heating and cooling system of the house, things that we personally probably don't know much about, but we want a professional to be able to help us with, and that's one of those out-of-pocket expenses that you can expect on the front end when you're looking to make an offer on a house. And the reason we want to do that is that if there is something with that house that we as a consumer could not identify, but a professional has identified, that is the opportunity for you to be able to walk away without any recourse. And that's why we encourage, and your real estate agents will encourage you to have an inspection so that you can make sure that if I'm spending $250,000 to buy something, I have a good understanding of what I'm getting into. And this is additional from the cost. This is purchasing the home that we don't know how the homes work. That's why we're having a professional help us have a better understanding of what that looks like. Once we go ahead and have that agreement signed, now we're going back to our lender, and now we're starting the process of our financing package being put together specific to the purchase price. So based on your purchase price and based on your down payment, what does my payment now look like? So again, we want to be proactive in those examples, and we want to be able to make sure that we're fully understanding what that looks like. And so making sure, again, that you've got really good handle on your financial documents, your bank statements, your W-2s, your pay stubs, that you've got those all ready to go, because once you sign a purchase agreement, not only are we agreeing to the actual price we're paying for the house, but we're also agreeing to the date we're going to close. And typically those dates are going to be anywhere from 30 to 45 days, maybe 60 days from the date we've signed the contract. So we've got a process that needs to be completed, and the process is helpful to all of us if we have, as lenders and consumers, if we have all of our documents ready to go as soon as possible in the process. Now, once you get into a purchase and you've got the terms determined of your price, we've talked about qualifying, and part of qualifying is going to be having a good understanding of what that financial commitment looks like, and the lender will submit to you what's called a loan estimate. And the loan estimate is the same document that all lenders use. It's created from the CFPB, and this document is unilaterally used in our industry, and it's designed to allow a consumer a clear and concise understanding of what my front end of my purchase looks like from a financial commitment. So if we look at a loan estimate, there's going to be information related to how much is my purchase price, how much am I borrowing, what are going to be some of the fees that are associated from a lender's perspective, which are fees along the lines of a credit report or an appraisal. There are going to be fees disclosed initially that will be from a title company, and all title companies will have slightly different fees to them. And title companies are an area where a consumer can shop, but a lender will show an initial estimate of what title fees would look like for a purchase of that price range and that loan amount. In addition to the loan estimate, you're also going to have an amount set up for the escrow account. So it will show you on a monthly basis what the estimated taxes are, what the estimated monthly homeowner's insurance cost will be on that. In addition to that, you're going to have to set up the escrow account, and the lender will walk through that with you as well, and showing that you're going to pay 12 months worth of insurance as part of the transaction, and setting up 2 to 3 months worth of insurance to feed that initial escrow account. Same thing with the property taxes. One of the other expenses in this transaction will be mortgage registration tax, and that's a tax that the state of Minnesota applies on purchase and refinance transactions in the state of Minnesota. And so that mortgage registration tax, unfortunately, is one of those fees or costs that's in there that all companies are passing through to a consumer based on the state of Minnesota. So if you look at the 3 buckets that you have in a loan estimate, you have the closing costs, you have the setting up of the escrow account, which is called the prepaids, And then you're going to end up having credits. So if you've paid for an appraisal up front when you've done this, that shows up as a credit, and that will show up as a credit later on in your transaction. So the loan estimate is really a good financial blueprint of what your purchase will end up looking like. As you're going through the transaction and the lender is educating you on your next steps and next processes, part of it is you're going to need homeowners insurance, which we talked about, so you'll reach out to an agent, and they'll help you understand. And agents are going to be a little bit different as far as what your coverage is and what your deductibles are, so it's good to have a referral to a real estate agent if you don't have one. And there's plenty of people and friends and family that can refer you to agents that will end up helping you understand what the cost of homeowners insurance is. But as you're getting through your process, the lender is taking all of this information and all of the documents, and they're submitting it to an underwriter. And what an underwriter is doing is they're basically saying, does this consumer qualify for the purchase that they're undertaking? And do the documents support the income that the lender has put down or that the consumer put down on the application? And really, that's what the underwriters are there to do, is to make sure that all of the documentation matches what the loan application says, and that the consumer has the amount of money needed to be able to execute the down payment and execute the closing, and that the consumer has the income to qualify for that purchase. And that's really what the underwriter is looking to do. And as they go back and forth, what can end up happening is you may get asked to submit an additional form of documentation, and that's quite common for that to happen. So if you do get asked for something to supply it, it's not anything to be worried about. It's that that underwriter is doing their job to ensure that the loan that they are approving has all the components required. When they get to the end and the underwriter has issued what's called in our industry a clear to close, what ends up happening at that point is that the lenders will end up then forwarding on, after a few days, what we call a package to the title company, and the title company is preparing that package for your signature at closing. And this is going to happen usually a week to 10 days prior to your actual closing date. So during the closing package, what ends up happening is that the original loan estimate that you have seen will now be transferred over to a new document called the closing disclosure. And the closing disclosure will have all of that updated information that may have changed from the original loan estimate. So if we estimated that your insurance was $100 a month and now it's $90 a month based on your agent, those changes are going to be made. So there's some conversation that happens between a lender and a title company to get your final numbers. And again, that's something that should be happening 7 to 10 days before your closing date. And the great thing for the consumer is that once that closing disclosure then gets generated, you're going to see a copy of it. So then you have now a much closer understanding of what that closing number will end up looking like for you. And in the closing disclosure, those same buckets that we saw on the loan estimate are still present on the closing disclosure. So we have the lender fees, we have all of the prepaids, we have all of the insurance, we have the tax set up, and then at the bottom line, it's going to show what does our money look like at the end. And again, here's an example of what a closing disclosure will look like, and it shows you your cash to close. And that's really what the lender will then help you with, is saying, here's the amount of money that you need. Here is the source of the money that needs to go to the lender, or excuse me, to the title company. Will it come in the form of a cashier's check? Will it come in the form of a wire? And that's what your lender is there to help you with. And again, if you're dealing with a good lender, those are conversations that are happening days before your closing, not in the hours before closing. And that's when you hear stories about people who may have had issues. It's because a lot of this work wasn't done properly in advance, and changes are happening at the last minute. And for a consumer, there's nothing more aggravating than having last-minute changes. So therefore, you want to make sure that your lenders are doing a great job in preparing everything that you have, so that, again, as I talked about at the front of our webinar, when you go to your closing, It's a pleasant, it's an enjoyable, and it's a fun experience. It's not a transaction that is creating stress for everybody. So when you go to the closing is really, again, something that shouldn't take a long time. And when I say a long time, really it's a 30-minute transaction. So what's happening at the closing is that you will be sitting there in many cases, in most cases, and as I do, I'm attending the closing for all of my clients to sit there and act as an advocate for you to answer any questions that may happen. The title company is there to help you as a consumer make sure you know what documents you're signing so that they tell you where to sign, how to sign, and they're going through all of those documents with you. Your real estate agent most likely will be there to help answer any questions that you may have if there was something about the home that you wanted addressed that wasn't addressed before closing. And in many cases, the sellers of the transactions may also be present at the closing. But once you sign those documents and once you hand over your funds and that's all done, then you get your keys and that's when you're all closed and ready to go. So again, the closing is the fun part, that's the exciting part, and really it should be a drama-free activity for all of us out there buying homes today. So I know we've covered a lot here today, and we've really just gone ahead and touched again kind of what I'm going to call a 30,000-foot view of purchasing a home in today's market. So at this point, what I wanted to do is take a few minutes, open it up for some of the questions that we may have had online, and I've got Frank here that's going to help me with some of the questions. Frank?
Yep. So one of the participants asked, I have a strong credit score with an older credit history. My husband doesn't have a credit score. He's never had credit cards or student loans, etc. Will this be a problem when we go to apply for a home loan, or could it be seen as a positive?
Okay, great question. So in theory, the question being asked is if I have two people applying for a purchase or applying for financing, and one of the parties is not as strong as the other party. There are literally a couple of different ways you can address this. The first way is that if you need the other party to financially participate with as far as purchasing and qualifying where we need their income, then yes, their credit score is going to be included. And when you're dealing with the credit score part of the equation, if I have a 700 credit score and my partner has a 660 credit score, it's the 660 middle credit score. That's the score that gets used in mortgage financing. So unfortunately, in that case, if we have one of the parties is not as strong, that's the credit score that's going to be utilized in this. Now, having said that, that doesn't mean that if we are not out in front of this early enough, that we can work on that other person's credit and try to help elevate it so it becomes less of a hindrance to us being able to be able to purchase a home. Now, the other part of the equation is that if we don't need that person to participate and one of the homeowners has enough income to qualify for the price range that they're looking for, then great. Then you can do it in that format and just utilize one of the consumers, and that way it allows you to be able to proceed forward with the best foot possible. Great question. Frank, do we have another question?
We do. Another participant asked, what are some lender rules, restrictions, and limits as a parent giving money to kids for a down payment?
Great question. And we see a lot of this. So when we're dealing with down payments, parents are able to gift a down payment to a family member for the purchase of a home. Now, the one thing I do want to make sure everyone's aware of is that if a gift is going to be forthcoming, it's important to let your lender know that, hey, I do have a parent that is interested in participating by providing money for this. If they are going to do that, the lender should encourage you a process of when to do it and how to document it. Because there are guidelines as far as if the money is showing up in a bank statement, that then a lender is required to then go to the parent and work through their financial documents to show the source of the money. So there's a number of tips that we can all use when we're getting money. The biggest tip I would tell people is that if you do feel that you are getting a gift of finance from a parent, that you let your lender know as soon as possible, and that way they can help direct traffic, as I say, or direct the process of how to do that. The one comment I do want to make is, and this is how I approach it, realistically, when I've got clients, I'm the quarterback. I'm calling the plays, I'm running the playbook, and I'm helping direct traffic to make sure that all of the processes that we have are done in the right order, and that realistically, that as we're going through the process, if there's a pothole coming up in front of us that we haven't seen, that we've done our due diligence early enough in the process to sidestep those potholes, sidestep those problems, so that they don't become a problem late in the game. And that's really what a good lender can do, is they're going to help you spot those problem issues well before they become an issue and learn how to solve them. So, great question though. Frank, do we have something else?
Yes, another participant asked, you mentioned that the interest from PITI won't change after locking the loan. However, how does an early prepayment of a loan affect the interest? It's a two-part question. Could I reduce long-term interest costs to me if I make larger payments than required or make extra payments? So we'll go back to the first part of that question, which is, how does an early prepayment of a loan affect the interest?
Okay, great question. So basically, if we look at a principal and interest payment on a loan of $1,000, and if you, as a consumer, want to contribute $1,100 at your payment, when you make that payment, you will note to the lender that you're asking to apply that extra $100 towards your principal. Well, if you keep doing that over time, what that does is it actually reduces the amount that you end up owing on your loan to when you get to that balance. And so we've talked about overfunding your payment on a monthly basis when applicable, or when you have the opportunity to, that it basically reduces the amount that you end up owing. Now, if we're in our home long term, realistically what that ends up meaning is that when I'm going to sell my home, because I've paid an extra $100 a month, I now own less on the home. That means I'll have more equity to transfer over to a new home. But the great thing about that is that if your interest rate is in a fixed rate, that interest rate will stay the same, and you're just continually driving down the amount that you owe, so that it allows you to either pay your loan off early or to be able to build up more equity, which is more profit from when you sell the home to when you go buy your next home. And we always encourage, if you have opportunity to pay a little bit more each month, always do it, because it just directly benefits you as a consumer. Frank?
You answered both those, thank you. The next participant asked, I have two credit cards, one newer and one older. If I close the newer one, my average credit age should be longer. Will closing the newer credit card hurt my credit score or otherwise damage my efforts to buy a home?
Okay, great question. We have multiple credit cards, and do we close accounts? I have always encouraged people, do not close your credit accounts. The reason being is we talked about earlier in the credit profile that the credit that you have versus the credit that you owe versus the amount of credit you have is a key element in our credit score. So if I have one credit card that has a $5,000 limit and I owe $1,000, okay, that's a 20% number. But if I have two credit cards that all of a sudden now have more range to them and I owe less on them, again, that just helps profile. So don't close credit cards, especially without talking to your lender, because your lender will be one of the people that can help dictate activity that can help improve your credit score. But yeah, I always encourage, don't close a card, especially if you're thinking about financing a home without talking to someone specifically that's knowledgeable about what the ramifications may or may not be in closing credit. But again, I always encourage people, don't apply for a bunch of new cards in order to do it, because that can offset one of those factors in improving your credit score. But great question. Frank?
Yep, so another one, could you repeat the question? So they can't hear me very well, so I'm going to speak a little louder. I just got that feedback.
Okay.
How much do student loans affect your ability to qualify for a mortgage? What if the only debt you currently carry is student loans? Okay,
great question. So many of us that are alumni, unfortunately, have student loan debt. And when an underwriter and qualifying person is looking at your qualifying, everything is outside of credit score. When we're talking about the dollars and the monthly payments, everything is based on what your monthly income is and what your monthly debts are. So if you have student loan debt, and we'll just say you've got $50,000 of student loan debt, but your payments are $100, it's not the $50,000 that's calculated, it's the $100 a month. So a student loan debt of $100 a month is treated the exact same way as a credit card debt of having $100 a month. That's how mortgage qualifying, that's the basis of mortgage qualifying is, what is my monthly income, what are my current monthly debts, and how much is my monthly new loan payment going to be on that house. And that's what your lender will help you understand of qualifying. So again, you can have the student loan debt, none of us like it, but it's not the total of the debt, it's the total of the monthly payment. And that's a great question. Frank, do we have another one?
Yep. I have a relatively new credit score. I have a small balance left on one of my student loans. I was considering paying it off completely. However, it is my oldest account and could drop my credit score. Would you recommend I keep this loan or pay it off immediately?
Great question. So it would be on student loans as a liability going into your credit profile of having the length of credit history that we have. And the student loan is going to be treated, that history component will be treated a little bit different than maybe a credit card that I've had for the last 10 years. I encourage people, if you don't have to make extra steps to just continue to make your payments and pay off your student loans, that's never a bad thing. But again, your lender can help you determine if paying off a debt will help your situation or if it will have no bearing on your situation. And that's really what the lender is there to do, is to help you make those good choices, to know, again, specifically what I should be doing and what I shouldn't be doing in advance of buying a home. Because once you're into the process, you don't want to be making changes, and that's, again, what your lender, what I encourage everybody to do. We're going to have those good conversations and make sure that we know specifically what our game plan is. Frank, do we have another one?
We do. What can you tell us about today's market in Minneapolis, St. Paul? Any suggestions?
Yes. Minneapolis, St. Paul for the first-time home buyer is certainly a challenging environment as we see it today. And this is coming forward even from last year. There are less homes available for purchase today, and there are more buyers looking to buy. And consequently, what that's created is kind of a hyperinflated price increase on homes today. And it's challenging for a first-time home buyer, and I can't tell you the number of clients that I'm currently working with and have worked with that have had to make 4, 5, 6 different offers before they end up getting a house purchase. It's tough. And the thing I would encourage, have conversations with your agent about market conditions. Understand that if you're going to pay above a list price for a home, what that means to you financially, and that's where your lender, and having that one-on-one with the lender or phone conversation with your lender, can help you understand that if I choose as a consumer to pay $5,000 more than the list price for a home, what does that mean to me financially? But again, it's a tough market out there right now, but the interest rates are absolutely at historic lows, and it is a really good time to buy right now. These are just really great times as far as the financing costs for home purchases. It's just you have to deal with the competitiveness of the buyer market, and I just encourage everybody, be patient. It will work out for you in the end, absolutely. Frank, we have one more?
Yep. Can you talk about being an international student and wanting to buy a house? What options do we have?
That's a great question. So if we've got international students, again, we want to talk about looking at what the criteria is for being able to, what's your income sources, what are your debt sources, what is your length of employment, things along those lines. So those are more what I'm going to call specific conversations that each consumer should have with a lender about what their requirements are with regard to financing. And again, as I talked about earlier, we've got financing is unique. There are generalities to it, but there's really specifics to you as a consumer that you need to have those one-on-ones with a qualified lender that has experience in the industry, that has experience to be able to help you, and again, that's interested in making sure that they're working in your best interest to help you have this process work as smooth and as clean as possible. The one thing I do encourage everybody is that when we're making home purchases, we are talking about some pretty large dollars. We're talking about 150, 200, 250, 300,000 or more cost and price to buy a home. This is not buying a home on Amazon that you can return online. This is a once you buy it type of a deal. So it's important to have that professional help to be able to help you in your decision-making process. And that's what, and there are just a tremendous amount of really good lenders in the Minneapolis metropolitan market here that can help you make good choices. And again, I just encourage everybody to try to meet one-on-one with local lenders. You know, groups like TCF Home Loans are local lenders that have got a big reach and can be able to guide you and help you with this lending process. So at this point, I'm going to go ahead and I'm going to turn it back to Rebecca. I do want to say thank you to everybody that has participated here today. My contact info is there if you've got questions outside of our webinar here today. And I want to thank the University of Minnesota Alumni Association, and I want to thank all the alumni for participating here in this webinar today. So, Skaujumago Gofs.
Thank you. Thank you, Dave, for this wonderful webinar. I really enjoyed it. I thought it was very informational. I'm sure many of our participants also thought it was informational as well. This webinar will be presented on our website, on our YouTube channel, and I will also send this recording to all participants and anyone who registered for this webinar but was unable to participate today. So you'll receive that by email as well as a survey. We'd love to have your feedback on today's webinar, and then also any additional webinars that you'd like to see us host in the future. So I'll send that out within the next day or so, and I look forward to having you participate in a future webinar as well. I also like to thank TCF for sponsoring this webinar and being a great sponsor, and for being an official bank for the Alumni Association. Thank you, and until next time.